Welcome back to the Behind the Well show. Your host, Roger Abel, back with Elias Randall. Elias, it's fall time. Football season's in full swing. I know you're in full refereeing mode. And I read an article the other day that I think was pretty neat. We've talked on the show a lot about lack of financial education and how high schools and colleges have never made this a priority in teaching individuals, and kids about the need for personal finance. And there's actually Stanford has rolled out a new personal finance class that is aiming to revolutionize the way that we learn and we think about money. And it's put together by an economist named Anna Maria Lasardi. And what she's really trying to do is actually start a class that teaches college kids the real fundamentals of personal finance, but also they actually can get college credit for it. Most of the personal finance courses that are out there aren't eligible for actual college credits. So who would take them and pay the money to do it? So I think this is like step one in the right direction of how do we start to teach kids about personal finance in a manner that is fun, engaging, meaningful, and there's some benefit outside of just the learning. Like if you're going to show up for class, you get all the credits too.
Well, and regardless of career, everyone needs personal finance and needs knowledge of how money works and how they're going to save their money and what they're going to do with it, which is there's a big gap right now between people that do execute good personal finance and people that don't. It's a small percentage of the entire country that really engages in personal finance. And we talk about that, like saving money, doing some investing. Everyone's engaged in finance, but unfortunately, a lot of families, they engage with borrowing money more than they do any other part of their financial life, or they're spending everything they make. It's paycheck to paycheck. Just even basic thing like having an emergency fund. There's a lot of families that if they didn't work for 3 to 6 months, they'd be living off of credit cards and stuff like that. So regardless of what you're studying in school, there's probably an argument to be made that everyone should have to take some personal finance classes. You're going to have a paycheck. You're going to be making money. Well, what do you do with that money?
One of the neat things about this course when I was reading this article, because I was captivated to it because, we've talked a lot about the lack of this. They're not just teaching the old school, here's your checkbook and here's how you balance it. They're actually engaging artificial intelligence, using phone apps and trying to bring technology and teach kids how this works. And as I went through the article, on one of the goals, she had half of the Stanford football team there. And it made me think for a minute, like, there's probably one or two of these guys who are going to maybe go on to the next level and play football somewhere, right? Like realistically, a college football team might have at least one NFLer on it.
Yeah, certainly at Stanford, I would think.
So what's the outcomes over a long period of time when you start to educate individuals on how to manage money? Does it help everything in the future, especially for like a football player who maybe came from a family that has no idea how to do this, and he's going to step into potentially millions of dollars and not know what to do with it. And then he's got to trust the people around. And, you know what happens when, people get involved with so-called financial advisors, the professionals, how many professionals have been scammed out of money, taking risky investments, and, they don't understand what risk truly is.
Oh, there's thousands of those stories.
Well, I mean, just think about it. You're a college kid. You don't hardly know what an investment is. And you go to a financial planner that was referred to you by somebody that you trust, and they tell you about this deal that you're going to get paid 8%. Well, okay, that sounds good. They didn't tell you, it's illiquid. You might not be able to sell it. It's highly speculative, all these different things. If kids understand that there's a risk reward and what's a reasonable interest rate, to come in, they start to say, well, what's the risk associated with this? What's the reward? How long is it locked up? Like they're relatively basic questions, but a 22-year-old just isn't going to think about.
Well, and you say relatively basic questions. That's probably something we take for granted, right? Those would be basic questions that we would ask and want to understand or guide people. This is what you should understand about this. But it's not a basic question for someone that's never had any education.
Actually, it's a great point. I was on Forbes this morning, and there's an article. I'm a money expert. Here's why I use a financial advisor anyway. So this individual, there's a money expert out there, and she's decided to delegate all of her financial life to a financial planner. Think about that. Someone who's considered an expert hired a financial planner.
Why is this person an expert? Do they write about finance or?
That's exactly what they do. But the number one reason they hired a planner was actually to double check their assumptions. So it goes back to how many times have we had an individual come in here with a spreadsheet and they have some knowledge, like they're knowledgeable, right? They've spent time on this. They come in with their spreadsheet and they're double checking what they've done and realize that the technology tools that we have are vastly better than trying to do this on your own on an Excel spreadsheet.
Yeah, the technology, the ability to have a conversation with an outside perspective too, right? Just what's the value in getting another set of eyes to look at something and then someone to have a conversation? And they might bring up, or maybe they'll ask you a question that you hadn't thought about. Talk about pros and cons of that decision. And there's a lot of value in just consultation of, yeah, you can make, here's two choices. You can make either one. Here's the pros and cons of each. But then you can make a decision that you understand the potential for either way and decide what you feel is best.
So the individual that actually is the money expert, she worked for Social Security Administration for years, but she also has a CFP. It's a certified financial planner. So she has all the tools to do this. Number one reason she decided to work with an advisor was to double check her numbers. The number two reason, creating a withdrawal plan. She didn't want to have to figure out where to take the money from. But number two, how to manage the money so that stock market losses didn't creep into her plan and they didn't matter that much, which is really like what we talk about when we do our bucket system for people. How are we going to create dependable income that lasts as long as you do with the least amount of stress at night if the market goes down? So I just thought those are really enlightening things that, someone who has a certified financial planning certificate has chosen to utilize a financial advisor to do this. And she has the skills to do it, but she's using them for a piece of this. It's the technology, it's the double checking, it's the strategy, because it's like anything. What'd you go to college for? What was your degree in?
Business degree.
Okay. So you have a business degree.
Business, economics, some finance classes.
Okay. How much about business did you know when you graduated college?
Like real practical knowledge?
None.
No, it's, a lot of academic knowledge, not as much just real world, how it really works knowledge.
You learn on the job, like you learn through training. So you can go get a CFP. It still doesn't mean you know anything about investing or managing money. Like you have the educational component, but until you have the opportunity to go deploy it and you get to see different scenarios and how things work in the real world, it's kind of irrelevant.
It is. And I imagine someone, in that position where you've been a financial expert, you have a CFP, concern is probably sequence of returns, right? Trying to figure out, what do I do if the market goes down the first year I'm retired? Well, then just educating on a strategy. I could see someone like that educate on a strategy, like the bucket strategy, and they'd probably think, oh, why didn't I think of that for myself? Well, but that's practical knowledge of how you can take money out. And that's one of the biggest questions we get from retirees all the time. The saving part was easy. Most people, it's in the 401k. It just happens over time. But almost everyone asks, how do I take this money out and not spend it all or not just use it all up? And how is the interest made? How are the dividends paid? How do I actually do this? And that's where if you can craft a strategy to help people spend or take withdrawals, there's a lot of value in that. And people need one of people's biggest fears when they retire: no more paycheck from the company, right?
Well,
Your accounts are going to become your paycheck.
Yeah. I don't think people recognize what the money's going to do for them. I think when people look at their 401k account, they look at that account and like, oh yeah, this is my pool of money. They don't like, when I see a 401k account, I'm instantly thinking, how are we going to generate income from this for you? Most people look at their 401k money and they just look at it as a giant pool of money. And it is, but the money has a goal. The goal is to generate you future income likely. Or some of the money is going to generate you future income. Maybe not all of it. Maybe some's for legacy. But people should have that little mind shift as to why they're investing money. Just to have more money, okay, that's good. But how much money do you need to get to where you want to go? That just goes out to like setting forth goals in financial planning. And, we get that a lot. Like, what should be most important as we start to work on a financial plan? How do we actually rank, our financial priorities? What's the most important part of financial priorities that you should have? And I thought today we'd talk a little bit about on the show, what are the most important priorities you should have? Like, where do you start if you're getting into the world of financial planning? Because there is a baseline. It's like building a house. Yep. And you go up from there. And I think one of the vastly overlooked parts of financial planning, and we actually had this discussion about 2 days ago in the office, how do we make sure people are doing this part? But it's really protecting yourself and your family.
Yeah, there has to be some sort of foundation. Like you just said, foundation to build on, foundation to make sure you're going to hit the goals.
One of the things people need to realize about insurance is that you have to protect your number one asset, which is your ability to earn a wage. That's your biggest wealth building tool. So life insurance, disability, auto insurance, homeowners insurance, and liability are really the baseline of building that foundation.
And it's really the risk management side of the business. Yeah. And for young people, I would say that's one of the more, just for example, having a good term life insurance policy that you can be the world's greatest saver, but if there's a tragic accident in your family and now a spouse is gone and there's no money to protect the family, well, what happens then? You could be doing a great job and kicking butt and doing your 401k and saving and doing great, but then that would absolutely derail your family's future success.
For sure. Well, and it goes into the second part of this, and really the second layer is get rid of all what we would call your bad debt. Bad debt, credit cards, high interest rate cards. Your mortgage is not bad debt, but you got to knock out the debt next before you start moving on to the next kind of building this house. You got your insurance, you knock out your debt. Then we move on to probably the most important thing everybody should have is emergency fund. I mean, it's arguably one of the most important tools people will have.
It is. And it's, I think we say this all the time, emergency fund, very boring topic. Again, it's something when you have something I see consistently, good savers doing all the right things, but then, okay, we have $10,000 in a savings account for an emergency fund. Could be a family making combined $250,000 a year, right? Saving good. Well, I can start to argue that, yeah, you're doing all these great things, but if you were not working, you don't have enough money to survive 90 days. And really, it can get more specific too. Like, do you have enough money to cover your out-of-pocket maxes with your health insurance, right? Because even if you could be working, but you get in a car accident, now you're in the hospital for a little bit. You're sick, right? Do you have enough money to cover just maintenance? Anyone who owns a house, your house is never going to stop asking for money. If you own a house and a car, when are those items going to stop asking for money at times?
Just like our friend, buddy of ours, has a kid who's looking to buy a house, He's like, well, the house payment's $1,400. I said, you should tell him it's $2,800 because he's buying a 50-year-old house.
Yeah,
so if the house payment's
is 50 years old,
$1,400,
there's going to be maintenance.
Right. If the house is $1,400 a month, there's going to be $1,400 in maintenance. It's not that cut and dry. I mean, think about it. That's why new construction's more money. Everything's new. You don't have to fix anything.
For a while.
Yeah. I always tell people
Eventually
it's 7 to 10
will.
years, right? It's 7 years, stuff starts to break.
Yep.
Like dishwashers go out in 4 years. You know, we've lived in our house for 8 years now, 7 years. Guess what? Time for a new fridge. It's not working right.
Yeah, we replaced our washer and dryer probably 4 years ago. The ones we had came with the house that we bought, and they were old, but good, right? Because it was made when washer and dryers were made to last.
Still?
And then I think something started. I think the washer actually, like a motor went out or something. So went from something that lasts 20 years and was in the house forever, bought new 4 years ago, and then within the last 6 months, the washer dryer maintenance person was at the house fixing a component that broke on it, which is crazy because you would think, okay, washer and dryer, we've been making these for 100 years, should last 20, 25 years.
They're
No,
good for 4 or
not
5.
anymore.
Yeah. No, but you know what? To your point about emergency funds, the good news is you had an emergency fund that wasn't, hey, we have to go use the Visa card to pay for this thing. It's how people get in financial trouble is not having the liquidity to handle the small events that come up. I think people have a misnomer that, you know, you go into debt by making big purchases. And I disagree. I mean, yeah, big purchases could put you into debt, but people are acutely aware when they make a large purchase, right? Oh man, I'm buying a car, it's $40,000. Like, you're aware of that. What people are less aware of is the weekly and daily stuff that they're putting on that credit card because it's convenient and it adds up to a lot of money. Oh yeah, we went to lunch today at Chick-fil-A and then Poncheros and I had a coffee at Starbucks and went over to Scooters. And the next thing you know, you put $300 on your credit card this week.
You barely even noticed.
And didn't even notice that
and that's
you did
easy
it.
to do. That's
It's
very
easy to
easy
do.
to do.
So with that said, it's paying off debt. Then next, we finally get into the point where you start saving for retirement. That kind of speaks for itself. One thing I would tell people, if you have a 401k match that you're utilizing, don't give up your 401k match ever at your employer. Always take advantage of that. And then after you kind of accomplish that goal, it's really, hey, do we have after we're doing retirement, what are the other goals that we have? Is it we want to pay for kids' college? We want to get a lake house. We want to move to a new house. We start saving for those goals. And then we start paying off like what we would call constructive debt. Constructive debt's really simple. That's our mortgages.
Yeah, mortgage, right? If you're a business owner and you have some lines of credit that you've used and you have the ability to pay them off, get them paid off.
And then ultimately, when all that's done, that's your ability to go give and fulfill your charitable desires. And I just thought it'd be good to cover that because I think people should look at their financial picture as a house and make sure they have a really sound foundation built before they start adding more stories to their building per se.
And people who are successful with money, they basically do all of those things. You know, it's basic, it's really 101, it's fundamental, but there's not many people that have built wealth and haven't executed those items. It's pretty common amongst all people who are financially successful.
And, you know, financially successful people, they know where they stand. You know, there are all the reports out there by employee benefit research where, you know, 27% of the people are actually confident about retirement. Well, guess what? About 27% of the people have done a financial plan. I think people, I think there's a misunderstanding of what financial planning is today. I think people still believe that you go to a financial advisor and their goal is to sell you a product. And I think our industry's had a massive shift away from that and more towards developing goals and priorities for people and understanding their situation and trying to get better outcomes for them through financial planning.
Well, and as the industry in general has transitioned to that way where it's more planning and advice, I think consumers can extract more value too, because you don't have to worry about, you know, and we talk with our clients all the time, the strategies, the products, the investments, they exist. If any firm can get the same strategies as the firm down the road, but if you're aligned with someone that you feel is working in your best interest and also aligned from philosophy, and you like the way that they work, their philosophy, the way that they plan for you and give ongoing advice, I think that's where consumers can really take advantage of the situation and engage in that. And, what's our goal here? Optimal outcome, right? You can have an outcome or you can have an optimal outcome. It kind of depends on what you're looking for. But there's no widget. There's no single investment that you're going to decide to do that's going to like make or break the situation.
Well, and it goes down to we're just trying to understand people's situation better. And it got me thinking about something. So in our industry, we have a level of fiduciary responsibility to figure out what somebody's risk tolerance was or is, right? We should know what their risk tolerance is. And for years, you'd go into your financial advisor, broker, whoever it was, and they'd say, oh, what's your risk tolerance? And ask you a series of questions to nail that risk tolerance down. And then the investment philosophy was based upon that set of questions, which only had to do with their risk tolerance of investing and nothing to do with any of their other goals. And I think one of the other ways the industry has changed is there's still a vast majority of advisors using just risk tolerance as the only metric, right? But I believe the people that are truly engaging in some meaningful planning for people are figuring out what someone's risk tolerance is, but then asking probing questions about goals and priorities. For example, there's a risk tolerance associated with a job. What job did you decide to take? Each job has more risk associated with it. And the more you understand about that individual and build a plan, the more you can craft investment plans that are based in this holistic picture and not just a series of 8 questions to determine whether you are good or bad or whether you're aggressive or conservative. And we call it risk capacity, right? That's what we quantify it as. And then we try to match this risk capacity and blend it with this risk tolerance to really build a great plan for somebody versus just saying, well, you're, a moderate aggressive investor and here's the one size fits all product that works for you.
Yeah. Moderate aggressive portfolio. Right. And there are folks that even in retirement, so they're older than 60 and they still want to be a growth investor, right? So if you want to be a growth investor, you have to own growth assets. Well, but then just in general, people feel, oh, when I retire, I need to move to the super conservative posture. But there's nothing wrong with investing for growth even after retirement. But you got to take into consideration these other factors. Are you going to take any withdrawals, right? Because if you're going to take withdrawals, then a portion of your money can't be invested for growth. That's not a prudent thing to do with all of the money. And there's also people who have done such a good job that their plan's going to work out kind of regardless of the risk they take. So maybe their risk tolerance might say, what if they were an entrepreneur? So they like a lot of risk, but they're to a point in their life where they don't want the risk anymore. Okay, well, do you need to have it? That's a different conversation.
So while you were talking, that's exactly what I was thinking about. If you think about inherently an entrepreneur business owner, their propensity for risk, whether people in the public realize it or not, is massive.
It's much higher than someone who's working a job for someone.
Let's just assume you have a staff of X amount of people and your monthly overhead's $150,000 a month. How many people in America would be like, feel comfortable knowing that they have $150,000 a month liability to start the month? Not a lot of people, right?
The people that own the companies and the businesses,
right?
do.
But if you go profile this person about their risk, it's going to come out they're ultra aggressive, right? Like they're aggressive, but that doesn't mean that their investment portfolio needs to be aggressive. The investment portfolio might be a complement to their business and not their primary vehicle for retirement.
Yeah.
Like I think about how I invest, you know how I look at my money. Okay, the money that I'm putting in all my retirement plans, that's my hey, I'm going to try to get a market return. It's my growth investments. It's nothing like flashy. It's the same mutual funds or ETFs that our clients are utilizing, right? But then my money outside of that, I've got a chunk of money that I do in real estate because I feel like that's the safer play to be diversified. And then my brokerage accounts where I go buy all the stuff with the risk, right? I made sure retirement was met. Then I have the safe investment. Then I have a riskier place that I get to go buy riskier investments with.
Yeah, and I think what I like about that approach, and I've heard a lot of people talk about this, that the long-term retirement dollars, those are a little more like, I don't know if sacred's the right word, but need a little bit more responsibility. Like if you're going to trade or take kind of bigger risk, do it in your trading account, your account that, well, hey, if I'm going to do these 5 ideas and if one really hits, great. I just hit a home run. But I don't know that retirement accounts is the place to be doing stuff.
No, let me
like
tell
that.
you why what you said makes sense. Your retirement account is where you should exhibit great investor behavior, right? Like dollar cost averaging, we're consistent, we're increasing our contributions. Your non-retirement account, after you've maxed all this other stuff out, and if you want to utilize it as, your riskier account where you have more risk on your investments, well, you're already not exhibiting great investor behavior if you think you can do better than the market likely. So the other thing about that account, you're not putting money in regularly typically. It's like, oh, I have some extra money, we'll put it in there. The other thing is, for most people, if they have a riskier investment account, not their whole portfolio, if they lose it, it probably doesn't matter, right? Like if you're maxing your 401k, you have the baseline for having some type of a decent retirement.
Right.
But if you're risking all of your money, that's just not a good thing.
Yeah, and that could be in funds, like in funds that are provided in there that you picked. It could just be as simple as a target date fund in the 401k. And target dates, maybe not specific. The risk in there and stuff might change over time, and that might not be aligned with what you want to do. But how many people, if you did that for 40 years in a 401k, are going to end, or at the end of it, are going to say, man, I'm upset that I did that.
They won't. They hit a home run because they didn't mess it up.
And, I think right now we're in this, just where the market is right now, I think we are at a place where, and I'm being more specific towards younger savers, people who are accumulating at this point. We're back to close to the all-time highs in the market. And that's when we start to get a lot of market timing questions and what should I do? And one, it's impossible to time the market. And one thing I've been talking with younger clients about, all the data and the research that we look at, the investor class in America is growing, meaning more investors are participating in the market. So that means the demand for equities, the demand for stocks is not going down, right? So you may hear all this stuff. You may listen to someone who, in the next year, the market's going to go down 20 or 25%. First of all, they have no idea what the market's going to do. And it's kind of hard to go against the data showing, one, the investor class in America continues to get bigger. Even abroad, internationally, I've been reading articles and hearing on CNBC about the investor class in Asia and China and Japan. More of their consumers are starting to invest and participate. So over the long term, especially globally, if there's more people investing into the different markets, how are we going to have stock markets that aren't a good place to make money? Now, if those numbers were going down, you could probably start to say, I don't know if this is good for me anymore. But until the businesses don't make money and there's less demand, because that's really how it's priced, the mechanics of the market every day. What is it really showing you? It's showing you were there more buyers or more sellers today.
And think about it. If somebody doesn't, the landscape that we are in from a retirement standpoint in America, if you're not going to invest in the stock market, how are you going to get to retirement? Like, what are you going to do? Like, you're going to be an employer and not do the 401k? You're not going to have a pension. Are you going
to put all your money in the money market? Like, even if you're going to participate, but you don't want to own equities, like you're going to buy bonds and money market, and you're
if you just say
35 years old.
Well, if you just say you'll never outpace inflation, you just won't do it. You'll never save enough money to do it. You have to have a way to grow your assets, and generally, the bank account is the best way to do it. It's a good way to preserve it. Now, granted, you could buy real estate and do that other stuff, but guess what? Your employer doesn't offer a matching contribution into real estate. You don't get to go to your employer and be like, well, I want to put my 5% into this, personally owned real estate investment. I'd like you to match my contribution there. It's not how it works.
No.
So unless the entire retirement system in America were to basically just get upended, how's the demand going to go away?
It won't. There's more and more. There's more young people participating. Like even in 2020, when you had all these young people open Robinhood accounts, that was just the start. And
it broadened the base. It broadened how many people are doing this.
Right. And the access to information and the promotion through social media. And I get questions from young people all the time. Like especially it might be, people we work with here, their kids might ask a question. I ref football. A lot of the officials I work with, if I ever spend time around their family and the kids know, oh, he works at an investment firm, they'll bring up, hey, what do you think about this? What do you think about that? What should I be doing? There's just more interest where, like a 16-year-old kid the other day asked me about a couple different stocks. You know what I wasn't doing when I was 16 years old? Thinking about stocks and asking an investment professional about them. It wasn't even on my radar.
Well, it's TikTok. It's the stuff they're watching. So it's coming up, which is then piquing their interest.
Right.
Right. And so it broadens the base. It also makes me think, does it put a little bit of a floor in the volatility? Like, doesn't mean stuff's not going to go down. It's going to go down. But if you think about to like 2022, the last, bear market we had, which seems like forever ago, but it was just, 20 months ago.
Right. And if you look at statements, if you look at statements, it doesn't feel like there was a bear market 20 months ago.
But there was. And it was the worst bond market we've ever had. But what I wonder and what I remember about 2022, there was so much information about there that was getting pressed to people about, hey, exhibit good investor behavior, don't panic, don't sell, like all this information. Did it actually, stop or put a floor in? Because there wasn't, sell and panic and get out. It was, hey, this is how you get through this stuff. And look what happened. People that followed that advice were positively rewarded over the last 20 months.
Yeah, so there is a theory out there. I think it's sometimes referred to the relentless bid. And kind of the theory is how much market volatility can we have if every week, every 2 weeks, once a month, you have all these contributions? Think how much systematic investing is happening in 401ks. And 401k contributions are not price sensitive, right? Typically they go in, very few people are going in and timing the market.
They can't, they just get deposited.
Yeah.
They'd have to deposit in cash and then decide what to buy. Well, that's just too much work.
Right. The money goes in, gets invested. So there's a lot of dollars that flow to the equity markets that are not price sensitive at all about the entry point where they buy. They're just buying.
Well, and look at the outcomes for people who start doing a 401k at 22, put 15% away. It's a pretty phenomenal outcome.
It is. There's a lot of people that did that, and they're young, and maybe younger than 40. That's more rare, but between 40 and 50, and they're already 401k millionaires. There's a lot of people out there that have done that. There's
almost nobody out there you're going to meet that would tell you they wish they would have waited to save. I'll bet if I asked you, you wished you would have saved more earlier.
Oh, absolutely.
Me for sure. I wish I would have saved more earlier. And it's really priorities, right? It is priorities.
Right.
For the first, people in our industry use the crutch, well, I'm just getting started putting my money into my business. Well, that didn't prevent you from saving $200 or $300 a month. You could have saved something.
Absolutely.
But it's just a reason it's reasoning and rationale as to why we can't do it. Well, I'm not getting a 401k match, so I'm going to invest in my business because that's a better long-term play. And arguably it probably is. But all those people who did that, I promise you, most of them would look back and say, man, I could have shoved $200, $400, $500 into a mutual fund when I was 24 years old. And I'd be really happy today that I did it.
Yeah, it's kind of in the future, what would you rather have? Would you rather have a business worth a couple $1 million and no investment accounts, or a business worth a couple $1 million and investment accounts worth a couple million?
Well,
I mean, and it's not, if you start young, it's not that hard to accomplish.
It's probably why we have catch-up contributions in 401k accounts.
Yeah,
that's
absolutely.
Why.
That's
It's
the main reason.
Because people at about 50 get really serious about it. I know for me, like I've always saved and done those things, but at 45, that was like, oh man, like I maybe have worked longer than I have left.
Probably.
I thought about like, me.
That's kind of spooky, right?
Well,
in a way.
Well, you know how I plan. I don't plan to retire because I like this, but I have the financial independence date that's where I plan my retirement, even though I don't plan on retiring. I just want to make sure I've saved enough to get to that point. And I'm not using, I'm going to work forever as a cop-out or scapegoat to not save. Because that's really what happens when someone says they're going to work forever. And here's what the statistics tell us. Statistically, 35% of people fall into the camp of I'm going to work at least until I'm 70 or I'm going to work forever. Do you know what the percentage of people that actually work past 70 are?
It can't be very high.
6%.
Yeah. I mean, working forever, you're going to physically lose the ability to work.
Everybody
and
loses
the mental
ability
capacity to work.
Yeah. So just think about the people that tell you that. Every time I hear that, I'm like, well, you just likely don't want to save. Like, it's one thing if you are planning on having a retirement date and you work longer. Like, we have a client who's, what is he, 74, 75? He's working and he loves his job. He doesn't have to work. These guys have all the money in the world. But he likes to have the purpose of going to the job and the camaraderie of the people there. And he's like, I don't know what else I would do.
Yeah,
that's totally different.
He's in that 6%.
But for him, it's not a monetary thing. It is complete enjoyment of what he does. But with that said, if anybody out there is looking to get help with their financial plan, please feel free to click the links in the description or go to btwellshow.com or premieriwm.com. You can get us as well. You can follow us on social media, Twitter, YouTube. I think we have Instagram going now. So you have any closing remarks for anybody, Elias?
Thank you for listening. We appreciate it.
Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. The opinions voiced in this show are for general information purposes only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial or tax advisor prior to investing. Premier Investments and Wealth Management and LPL Financial do not provide tax advice. Please consult your tax professional. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. There's no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. Rebalancing a portfolio may cause investors to incur tax liabilities and/or transaction costs, and does not assure a profit or protect against loss. All performance referenced is historical and is not a guarantee of future results. All indices are unmanaged and cannot be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal. This recording contains only general descriptions and is not a solicitation to sell any insurance product or security, nor is it intended as any financial or tax advice. For information about specific insurance needs or situations, contact your financial professional. This video is intended to assist in educating you about insurance generally and not to provide personal service. They may not take into account your personal characteristics such as budget, assets, risk tolerance, family situation, or activities which may affect the type of insurance that would be right for you. In addition, state insurance laws and insurance underwriting rules may affect available coverage and its costs. Guarantees are based on the claims-paying ability of the issuing company. If you need more information or would like personal advice, you should consult an insurance professional.